let's move forward with these return measures. All financial assets have two common characteristics. All of them. And this is why we can compare them, because they have these two common characteristics. So we have an X and Y coordinate plane that we can plot all of these asset classes and see how they relate to each other. They have an expected return, and they have uncertainty regarding that return. And that we call risk. And we've just come off a reading on risk management, and we know that the steps in the risk management process, step 1 and step 2, was identification and assessment. And that's what this reading does when we talk about portfolio risk. Now that we have the word risk, well, how do you actually capture it in a number? And we did a little bit of that in quant. Well, not a little bit. We did a lot of it in quant, and a little bit of application. This is truly just applied, so that the math that we're doing on measuring risk has already been covered. We're really just looking at how do you apply that now, and what new things do we bring in that's distinct to portfolio management. So just to place that in a context. So all financial assets can be described by risk and return. So let's deal with return, measures of return, before we get to measures of risk. Return typically is derived from two different sources, from income, whether it be in the form of dividends or interest, or from capital gains, and let's face it, we're not always right, capital losses as well. So the different types of return measures we can have. Number 1, a holding period return. We've seen this before, where our return is simply the price of an asset at the end of a period minus the price of the asset at the beginning of the holding period, plus any income derived, divided by our initial investment, which was the price at the beginning of the period. So PT minus 1 over here. This will measure our capital gain or loss. And DT over PT minus 1, this is our dividend yield or our coupon yield, whatever D happens to be. It could be dividend, could be income. And that's the basic formula for a holding period return. So if our holding period spans multiple periods, so here's a nice little timeline. We'll use this quite often. Here is today, here's a year from now, 2 years from now, 3 years from now. Let's say we buy an asset today and we hold it for 3 years. And over those 3 years, in year 1 it has a particular return, in year 2 it has another return, in year 3. To calculate a holding period return is actually very simple. Is whatever we have here will be worth something at T1. It'll be worth 1 plus R1. $1 will grow at whatever that rate is. Then at T1 it will grow at a rate of R2. So we multiply by 1 plus R2, and then of course 1 plus R3, it's just compounded for 3 years. Take out the 1 because we added 1 to each one. Take out the 1 and we'll get a percentage return. We'll get a holding period return. An arithmetic mean. Now an arithmetic mean assumes no compounding. When we're looking at arithmetic mean, all we're doing, we're saying what is the return in each period? Great. Now what is the average of all those returns? And that'll give us an expected return per period, but it won't give us what, well, if we invested $1 at the very beginning of the time period, what would we have at the end of the time period? It doesn't give us that. It assumes no compounding. So here, to sort of simplify matters and to make it clear, let me show you here what an arithmetic mean measures. Imagine we put $1 in at T1 and we have a negative 50% return. That would give us 50 cents at T1. At T1, let's say that we have that $1 back again, and we have a 35% return, which means we would have $1.35. At T2, it assumes that we start again at $1, and we would have $1.27. So it doesn't say that we have $1 that goes to 50 cents, then the 50 cents grows at 35% to some number, and then it goes. That's not arithmetic mean. Arithmetic mean just says, hey, every period, start over. You have $1, what do you end with? Measure your return. Okay, great. T1, start with $1. What do you have at the end? Measure your return. Great. T2, start with $1. So that when we add them all up and divide by the amount of observations we see, we get an arithmetic mean. It tells us only the average return over a given random one-period time frame. That's all. And all we do is we add up all the returns, the sum from I equals 1 to t, all the time periods, and we add up all the returns and we divide by t, or multiplied by 1 over t, it's the same thing, and you'll get the arithmetic mean. So let's go ahead and just do this example here. Let's see what the arithmetic mean is that we get here. So the arithmetic mean is simply just you add up the 3 and you divide by 3. So our numerator is going to be negative 0.5 plus 0.35 plus 0.27, and we'll divide that by 3, and we will get 4%. Which is wrong. If we're looking at, well, if you put $1 in at time t0, how much do you have at time t3? You could not say, well, you have a compounded return of 4%. That's not what this is saying. This is saying that if you had to come up with an expected return for any given period of time, what would your best guess be? Well, 4%. 4% says, well, in any one period, the expected return is 4%. That'll have huge variability here. Remember, we measure that with standard deviation, but our arithmetic return just says that's our expected return for any one period or any one period time frame. That's all that is. Well, let's look at the geometric mean. Again, we've seen this before in the quantitative series, but I'll just go over a nice example with you. This considers compounding. So how does this look? This assumes that, well, we start with $1 here, and we have a negative 50% return. We'll end with 50 cents. For the next period, we grow at 35%, so this will grow to 67.5 cents, and then that grows at 27%, and that'll end us at 85.725%. So it represents growth over a given time period as opposed to just what the expected return is in any one given time period. This is growth over a particular time period. And it can be expressed this way. How do we get to it? Well, let's look at what we have inside the brackets first. We have our 1 plus our return in any one given time period, and this is a multiplication. So we're going to multiply 1 plus negative 0.5 times 1 plus 0.35 times 1 plus 2.27, and then we're going to take the root of it for the number of periods of time. We have 3 time periods here. This would be root 3. The other way to do it is simply just raise it to the power of 1 over 3. So the third root of all of this is the same as all of this raised to the power of 1/3, and of course minus 1. So let's go ahead and calculate the geometric mean for this that we have. Again, it's just 1 plus r multiplied for every time frame. So what do we have? We have 1 plus negative 0.5, so it'll be 0.5 multiplied by 1 plus 0.35. Multiplied by 1.27, and we multiply all of that out. That's this term in here, or it's this term in the square brackets, and we can either take the third root of it, or we can put it to the power of 1/3 minus 1, and that will give us 0.094995 minus 1, which will give us negative 0.050046. Well, now let's look at something a bit more advanced. We'll look at the money-weighted rate of return. The money-weighted rate of return is the same as calculating an internal rate of return. So all we have to do is specify our cash flows and then determine the internal rate of return that equates those cash flows to 0. So what we're going to do is we have 2 different types of cash flows. We have the same return in every period, but instead of having one return, what we're going to do is we're going to show that with the money-weighted return, the return is dependent upon how much money you put in at what particular times. So let's start with this one. What do we have here? We have, we're going to put 10,000 in on day 1, and that's bad because we lose 50%. We're going to add another 1,000 at T1, where we will grow for a little bit. Then we'll add another 1,000 at T2, where it'll grow, and then we figure out what we have at T3. So all we need to do is we need to list our cash flows. So our cash flow at time 0 is negative 10,000. Our cash flow at time 1 is negative 1,000. Our cash flow at time 2 is negative 1,000. And our cash flow at time 3 is, well, we don't know. So we just have to figure that out. That's not hard to do. This 10,000 will grow at negative 50%. This 10,000 will become 5,000. To that, we will add 1,000. So we'll start the next year at 6,000, which grows at 35%. and that 6,000 will grow to 8,100. To that, we'll add another 1,000, and we'll start the year at 9,100, which will grow at 27%, and we'll end with 11,557. So we can see that if we're going to model our cash flows, here's our outflows. Our inflow here would be 11,557. So we're now ready to put our last cash flow in, which would be positive 11,557. And we'll just use the calculator for our cash flows to figure out what our return would be. And if we solve for IRR, remember, this is what we're doing here, is we're putting in all of these cash flows on the top, and we're discounting it by some 1 plus the internal rate of return to whatever power it is, and we're setting that equal to 0. The calculator will solve for this IRR. That's what we want. And if we enter these cash flows in exactly as they're specified here, we will get negative 1.35%. Does that make sense? Well, we put in 10, 11, 12, and we're getting out 11,557. So we know we're going to have a negative rate of return on this. We know we are. And of course, negative 1.35. That looks like it makes sense. Good enough. Well, let's take the same returns, but let's just change the sequence of cash flows. Here, our cash flow at time 0 is negative 100. Our cash flow at period 1 is negative 950. Our cash flow at period 2, we see that we withdrew $350. So we actually get 350. And our cash flow at time 3 is, well, we don't know. That we have to solve for. So that's easy enough. Our $100 that grows at negative 50% will end at $50. To that, we'll add $950 for 1,000. Our 1,000 will grow at 35% for $1,350. To that, we will subtract $350, and we end at 1,000. Our 1,000 will grow at 27% to end at $1,270. And since that's the last time period, we'll assume that that is a cash inflow of $1,270. So now we can fill in this at $1,270. So again, we're looking at this formula. We're equating it to 0 and solving for IRR. When we do that, our IRR here that we get, when we enter this into the calculator, specify these cash flows, we will get 26.108%. So the same period of time, 3 years, the same returns in each year. Investor 1 has a different cash flow than Investor 2. Investor 1 realizes negative 1.35% return. Investor 2 realizes 26% return. So you have to be aware not only of what the returns are in any one given period, but how much money are you dedicating to the market in those particular periods. Investor 2 dedicated some money after a big sell-off. That's where they went in heavy. Well, that kind of makes sense, right? When markets are rising and you're dedicating money to the market, you should dedicate less and less and less as the market goes up. And as the market starts dropping, you should dedicate more and more and more. And if you change just the distribution of your timing, the distribution of the cash flows, I shouldn't say the distribution of your timing, but the distribution of your investments over time, depending on the market direction, you may be able to achieve a higher internal rate of return than not paying attention to where you're starting, where the market level is when you start investing, right? So, the money-weighted rate of return, here's an important point at the bottom now. It accurately reflects what a specific investor earned, but it lacks comparability. So we can't really say this portfolio here delivered 26.1%. The portfolio didn't deliver 26.1%. The investor's sequence of cash flows, the decision on their cash flows delivered 26.1% for them. But to get that 26.1%, you would have had to invest in the same things at the same time, at the same dollar amount each time to realize that return. We'll turn to the time-weighted rate of return now. And this measures the compounded rate of growth of $1 over the measurement period. So we don't have to worry about the money. We've taken money out of the way. We're saying, hey, it's a buck. It's a buck. Every period, what's the return on $1? That's it. So all we care about is the holding period return over the course of how many holding periods we have within the one measurement period. So Let's have a look at a timeline example here. Let's say that we have several quarters, P1, P2, P3, P4. This represents 1 year, quarter 1, quarter 2, quarter 3, quarter 4. We can calculate a holding period return. If this is a hedge fund that does quarterly evaluations, we can calculate a holding period return for quarter 1, for quarter 2, 3, and 4. Our time-weighted rate of return, in this case, 1 plus time-weighted rate of return to the n, whatever our n happens to be. This might be years. It might be 2-year periods. We don't know. Just we want to have some general statement we can make, right? Equals, and we just string these together. 1 plus holding period return for 1 multiplied by 1 plus the holding period return for 2 multiplied by the return for 3, for 4, all the way to n, whatever it is. So let's just have a look at what that would look like with just an easy example. Remember, we already figured out our holding period return for the contrived example we had earlier, where we made 15% in year 1 and 6.67% in year 2. So this is t equals 0. This is the end of year 1. This is the end of year 2. Since it's for a 2-year period, we're looking for the time, 1 plus the time-weighted rate of return, but it's squared because it's 2 years, right? Our n is for however many years. In this example, if these were quarters, our n would have just translated into 1, but we have 2. So that will equal all of the holding period returns strung together. 1 plus holding period return 1 times 1 plus holding period return 2. If we had multiple observations of holding period returns in here, we would string them all together. So let's put our numbers in. 1.15 and 1.0667. Since this is squared, let's take the square root of both sides. We'll get 1 plus the time-weighted rate of return equals the square root of our holding period return strung together. Let's get rid of the 1 on this side. We'll subtract it from this side, and we get 10.76. You'll notice that our money-weighted return was 9.39% because it overweighted the second year. Our average, or our mean weighted return, was 10.84%. Here we're getting 10.76% because we're not just adding the 2 and dividing, we're actually compounding. So this makes a lot more sense to do it that way. This is the preferred measurement. So let's do an example with everything here. Here's a 5-year period of time that we're going to observe a particular fund. Here's its assets under management. It started year 1 with 30 million, had a 15% return, started year 2 at 45 million, lost 5%, then 20 million, made 10, had 25, made 15, started at 35, made 3. So during throughout this, it looks like there's going to be some inflows and outflows of money going on, because 30 at 15%, growing at 15%, doesn't get us to 45. So when we get to money-weighted return, we're going to have to figure out what the inflows and outflows are. What's our holding period return? That's easy. All we need are just the returns. We're not even going to consider what the amount of money was. We just need the returns. If we put $1 in at the beginning of the period, at the end of the period, what would be the return? Now, we're not looking at the annual return. That's a geometric mean. We're just looking at what is the total return. That's why it's called a holding period return. So for that, we'll just take all of our returns, 1.15 times 0.95, 1 minus 0.05, right? 1.10, 1.15, and 1.03. And we'll multiply all of those together, and we will subtract 1 to get our percentage, and we will get 0.4235, or 42.35%. So we can say that over that period of time, I earned 42.35%. But that's a 5-year return. That's not an annual return in any mean. That's just over your whole holding period. That's what you've got. And that's what HPR is, just a holding period return. Let's calculate the arithmetic return. And this is easy. You just take the average. All we're doing is we're just adding them up. 15 plus -5 is 15 minus 5. Plus 10 plus another 15 plus 3, and that is all over 5. If we do that, we will get 7.6%. So our best guess as to what the return will be over year 6, if we use an arithmetic mean, our best guess, our expected value of what it'll be 1 year out, will be 7.6%, because that's the average return in any one period. Of course, it's going to have some kind of measure of dispersion, so we can say 7.6, but how confident are we in the 7.6? We have to look at the measure of dispersion, the standard deviation. What's the geometric return? In other words, what is the compounded annual rate of return if we had put $1 in year 1 and come out with, at year 5, what would we be looking at? Well, again, all we need are returns, right? So to get that, let me show you a shortcut. Because what we have to do is we have to multiply 1 plus each return. Well, we did that in the holding period return, right? And then we subtracted 1 to get to 0.425. Well, let's not subtract the 1. So all we have to just do is this. It's our holding period return, and re-add the 1 plus 1 to the 1/5. And then subtract your 1 outside, which will give us 1.4235 to the 1/5 minus 1, which gives us 7.317%. To see why that works, you have to understand that the holding period to calculate the geometric return, you're doing all of this anyways. You're doing all of this anyways, and then you're putting it to the power of 1 over 5. Well, this 0.4235 is all of this minus 1. So all of this must be 1.4235, which is why I just left 1.4235, because it's already calculated to the 1/5 minus 1, 7.317. Let's do the money-weighted rate of return. This one's a little bit tricky, right? Let's model our cash flows. What do we have? We have 30 that went in at this period of time. That 30 grew at 15% to 34.5 million. But it says that we started year 2 with 45 million. So how do we get to 45 million from 34.5 million? Well, we must add 10.5 million. 10.5 million must have went in to get us to 45 million. And that 45 million experienced a 5% drop. So at the end of T2, we had 42.75 million. But it says we started the next period of time, the T3 period, we started at 20 million. So something must have happened here. We had to get rid of 22.75, so 22.75 in terms of outflows, which is a cash inflow in that sense, right? And that brings us down to, if we subtract the 22.75, that gets us to 20 million that we needed to start. That grew at 10% to 22 million. But we started the next year at 25 million, so 3 million must have come into the fund for a total of 25 million. That grew at 15% to 28.75 million, but we started at 35. So we must have added more money, 6.25. If we add 6.25, that gets us to 35. I want to keep consistent with my colors here, sorry. That gets us to 35, and that grew at 3%, 35 at 3%, and then we'll say that that was the cash outflow, so 35 at 3% means 36.05 on the way out. So let's model our cash flows. Our cash flow at time 0 is negative 30, because 30 went into the fund, so we'll consider that a cash outflow, right? Our cash flow at time 1, we added another 10.5 to the fund, so we have another cash outflow of 10.5. Cash flow equals negative 10.5. Cash flow at period 2 equals, well, we withdrew 22.75, so that came back to us now. So that is a positive, that is a cash inflow back to us now of 22.75. Our cash flow at time 3, let's go to time 3. We added another 3 to the fund, so we have a negative cash outflow. Cash flow at period 4. Let's go to period 4. 6.25 went into the fund, so that had to be an outflow for us. And then cash flow at period 5 equals an inflow of 36.05. So if we enter that into our calculator and calculate the IRR on that one, it will equal 5.86%. 5.86% is the money-weighted rate of return. So before we dispose of the screen, we've done the calculating. Let's go back and interpret everything that we've done. What is the holding period return? What is that? That is the return over the full 5 years. I started at $1. I'm going to end at $1.4235, period. So in other words, my holding period return was 42.35. It does not consider how many periods you've held it for or whatever it is. It's simply just your holding period return. That's it. It's not very useful because you can only compare it with other people who have the exact same holding period return in the exact same time, maybe just another asset class. But they have to start on the same date and end on the same date. Not very comparable. The arithmetic mean. Again, that's not very comparable either, and it's not very useful because it doesn't tell us what $1 invested on day one would have grown to. So as far as a historical number goes, it doesn't really give us a lot of information. What do we use it for? It gives us our best guess as to what a random one-period return would be. That is our average return. So if we were forecasting a year ahead, we would say our expected return is 7.6%. with a standard deviation of, well, whatever the standard deviation would be. That's where our starting point for our expected return would be. The geometric return of 7.317 tells us, well, if we would have put $1 in on day one, we would have experienced a compounded annual return of 7.31% over that 5-year period of time. And of course, it's lower than the arithmetic mean because there is variability in the returns. What does the money-weighted rate of return say? It says, well, that's all fine and dandy with the geometric return, 7.317. But what if I committed money to the market at different times? What if I increased my commitment to the market as the market went down, and I decreased my commitment to the market as the market went up? I'm going to invest every year. I'm going to put money in the market every year. But if the market is higher this year than it was last year, I'm going to put less money in. If the market is lower this year than it was last year, I'll put more in. I can do better than the geometric return simply by making decisions at each time period that I'm going to put either less or more into the market. Now that's of course over a long holding period of time. This IRR is 5.86% that was experienced, which is less than the geometric mean, which is saying that, oh, well, when the fund lost money, chances are a lot of people withdrew money when they should have been putting in money. Is that what happened? Well, look, from T0 to T1, the market is up 15%. People committed more money. Then it dropped 5% and money fled. Right when the market was up 15%, the inflow should have been small. When the market dropped 5%, the inflow should have been large. So we should have seen an outflow here and an inflow here if you were trying to dollar cost average based on relative returns over years. Money left right when it shouldn't leave, hence it underperformed, 5.86%. There's our interpretation of what all these returns are. So let's look at annualizing some returns. We may be looking at several asset managers or portfolio managers and trying to assess their performance, but we may not have perfect years to look at. We may have a number of days or maybe a couple of weeks or whatever the case is, and we need to figure out how do we compare all of these. Well, we annualize the return. Now, there are two problems involved in annualizing returns, and something for you to think about. I'm going to show you the way the CFA text would deal with it, and I'm going to show you how I would think about it. So let's look at how we annualize something, and it's quite simple. It's 1 plus whatever the return we got over that holding period of time in days or whatever it is. And the power term is how many times a year we can repeat that investment holding period. So we got 0.2% for 1 week. So to annualize that, it's just 1.002, and then we have to worry about our power term. It's 1 week. Now, here's where the CFA and I will deviate. The CFA says, well, there are 52 weeks in a year. That's 1 week. The power term should be 52. And I say, no, that's wrong, because we all know there are not 52 weeks in a year. That's a common misconception that 1 year is 52 weeks. That's wrong. There are, in fact, 365 days in the year. We know that. And there are 7 days in a week. So I would put it to the power of 365 over 7. And then we can take out our 1. That will give us 1.09. Sorry. 1.1098 minus 1, which is 10.98%. So, you probably are wondering, what do you mean there aren't 52 weeks in a year? Of course there are. As a kid, I remember 52 weeks in a year. Well, 7 days in a week, 52 weeks in a year, 7 times 52 is 364. There are no 364-day years. There are none. They're either 365 days, or in a leap year, they're 366 days. So 7 times 52 does not equal a year. Now, when we did fixed income, we went through the fixed income playlist and all the readings there, and through the quantitative playlist and the readings there, especially on time value of money. One thing that was drilled in was that the days matter. We changed day count conventions from 360 to 365 because those 5 days matter. When something ended on a weekend, if a coupon payment landed on a weekend, we made the calculation to back it up or move it forward. Every day mattered. And suddenly here, we want to throw out an extra day by making the power term 52 over 7. We want to suddenly throw out 1 day of the year. No, I think that you should be consistent. If we're going to be specific as to the days in time value of money in both quant and fixed income, you've got to do it here. Number 1. Okay, let's move on to our next return. What do we have here? We have 0.4%, so that's 1.004, and it's 15 days. That's nice and easy. Our power term will be 365 over 15 minus 1, which will then give us 1.10201 minus 1, which is 10.201%. The last one is 1.5 years. So we can think about this. We can count the number of days and actually do it. Or we could just say, well, 1.5 years is 3 6-month periods. Because we don't really know how many days are in here, do we? We just know it's 1.5 years. You can't just say, well, you see, in 1 week, we know that it can only be 7 days. Here it's 15 days. Here it's 1.5 years. Well, it depends. Our day count will depend on what day we started. So if our 1.5 years ends up including 2 Februaries, well, then we're going to have a different day count than if it only included 1 February, right? So, but we do know that this is 3 6-month periods, and 1 year has 2 6-month periods. So all we have to do is 1.142 over, we want to annualize it, so we want 2 6-month periods, but we're dealing with 3. So it's to the power of 2/3 minus 1. That will give us 1.09255 minus 1, which is 9.255%. There we go. Let's do another problem, and here in this particular problem we have to pick a winner. We have to say, well, we have 3 returns. Which one was the better return, annualized? And here's where I'm going to point out the second problem I have with annualizing returns like this. But let's just go ahead and then I'll point it out after. We have 6.2% for 100 days, 1.062, 365 over 100. Minus 1 is 24.55%. The second one, we have 4 weeks. We know there are 7 days in a week. We know this is 28 weeks because these 4 weeks, it doesn't matter what day we start on, it's only 4 weeks. If it said 1 month, well, which month? We don't know which month. Then in that case, you would just say, well, there are 12 months in the year. But here, we know how many days there are. Let's be specific, 1.02. And we'll put it to the power term of 365 over 28 minus 1. And that will give us 29.45%. If we had used weeks instead, and if we had the power term instead of 365 over 28, if our power term instead were 52 over 4, let's say that was our power term, we would have gotten 29.36%. 29.36 versus 29.45. Now let's say that the base was $1 million and that you're on the receiving end of the gain. Are you going to say, oh yeah, give me 29.36? Or are you going to say, no, 29.45? You're ripping me off by a day over here. You're going to argue for the 29.45 if you're on the receiving end. That's only $1 million. Imagine if the base were $1 billion. You want that extra 0.09. You want that extra 0.09. So that's why I don't like the 52/4, because it understates the actual annualized performance, because we're basing it on a year, 29.45, right? What does the 5% get us? It's 1.05. Now, this is a 3-month period. Well, we don't know what 3 months, so we can't come up with an exact day count. If we have February, March, April, that's the shortest day count that you can get, because you have a 28-day, a 30-day, and a 31-day month. If we have July, August, September, that's the longest you can get, because you have 2 31-day months and a 30. We don't know. We'd need to know the dates. Now, normally you would know. If this is the return, you can simply say what was your in day, what was your out day. You can do a full day count on this. You don't have to just say 3 months. You can do a full day count. But in the absence of that, we'll just say 12 months over 3. That's as precise as we can get given what we have. Minus 1 equals 21.55. Now, if we had been able to get more precise, it still would have been in the neighborhood. Look at the other returns. They're way out. So this lack of precision doesn't hurt us down here, because it's out of the money. It's out of the running for these two. So the 29.45 appears to be the superior annualized return. Now, here's the problem. These annualized returns assume that you can replicate that return every single time. 6.2% over a 100-day period. Can you do that 3.6 times a year? Maybe you can. I don't know. 2% in 4 weeks. That means you'd have to do 2%. You'd have to be able to do that about 13 times a year. I don't know about that. 5% over 3 months. Can you do that for 4 times a year? Maybe. That's starting to get a little bit more realistic. So annualizing the returns and looking at something like this might have just been a period of incredible luck. Let's not forget the power of luck. There have been many times where my return, if you look at a return that I get, and somebody says, well, that's pretty good, my answer would be, hey, I got lucky on this one. I got just lucky. And I'll admit I got lucky. That had nothing to do with my skill. I just got lucky. So when I see 0.2% in 1 week, and then we annualize it to get 10.98, is it possible that this can be replicated 52.17 times or 52.14 times to get to the full year? I don't know. So let's be careful when we annualize a rate. Somebody can have a really great day, annualize it, and say, I did 735% return annualized today. Yeah, but you're not going to be able to maintain that. That's a ridiculous statement to make. So we can go ahead and annualize certain returns, but the shorter the period, 1 week, 15 days, 4 weeks, the shorter the period, the less reliance you can have that this can actually be maintained throughout the entire compounding periods. So let's look at portfolio return. We have already seen this before. It is the weighted average of the individual returns. So we just look at what our weighting is for each asset class, and we weight the return on each asset class by its weighting in the portfolio, and we sum them up. And all the weightings, of course, add up to 1, because whatever the size of your portfolio, most people say that they think of this as your investment. And your investment, it gets put into different asset classes, and it must all add up to 1. That's not true. If I'm using leverage, I can have my investment, the weights being greater than my investment. The weights are the total portfolio value of the total portfolio value, so it must add up to 1. So we've seen that. No real reason to go into that too much. Other return measures, gross versus net returns, and this matters for mutual funds. If we're comparing mutual funds, are we comparing them on their gross returns or their net returns? Well, if you're judging the performance of the asset manager, gross returns are what you want to look at, because that's the return before I charge everything that I charge, all my management fees. So if I'm looking at how good is the person, not what my return is, but how good is the asset manager, I want to look at gross returns, right? And our gross returns are our total returns minus any trading fees, and that's pretty typical. nobody would fault you for taking off your trading fees off your return, because that's a cost of achieving that return through either crossing the spread, the bid-ask spread, through either brokerage fees or your trading fees that your broker will charge you. There are exchange fees and there are brokerage fees. And this is the basis for comparing manager performance. However, if we're looking at where we want to be, there's no point in being with a really great manager who's pretty much going to take most of the winnings for himself. Well, I'd rather be with a mediocre manager that passes most of it through to me at that point, right? So the net return is the gross return minus any management and administrative fees. This is what the investor earns. Now, these management and administrative fees are fairly constant even with scale. So going from a $100 million portfolio to a $200 million portfolio doesn't double the fees. It doesn't double the fees, so that what we have here are smaller funds are disadvantaged when compared on net return, which is why they want to be compared on gross return, because that'll attract more assets under management. More assets under management will start to pull the net return closer to the gross return, because all of the fees will become not that important as you get more and more money under management, right? We'll continue on with some other return measures here. The pre-tax and after-tax nominal return. And this is a little bit more important than you might at first think. Let's remember about the components of the gain that we can realize. And when I say the components of the gain, I mean the numerator. Remember when we calculate the holding period return, we had the numerator, which was a combination of the capital gain or loss plus the income. Well, our capital gains can be of two types: short-term capital gains or long-term capital gains. Long-term capital gains typically have a preferential tax treatment. So all things being equal, we would prefer long-term capital gains to short-term capital gains. Short-term capital gains, as any active trader will tell you, are treated the same as income. They are not very tax efficient at all. So as you start making more and more money as a trader, you start thinking, I gotta start making longer term capital gains if I'm gonna make them, simply because I get a favorable tax treatment. Income can be divided between, income can be derived from either interest income or dividend income. And interest income is taxed at your marginal tax rate, not very tax efficient. Dividends are far more tax efficient. They have preferential tax treatment. So if you're going to be in fixed income, you might want to start looking at preferred shares versus corporate bonds, simply because the preferred shares provide a dividend stream of income. Again, one is far more tax efficient than the other. So your after-tax nominal return becomes very important, and you start thinking more in terms about more tax-efficient investment vehicles when you look at that. Now, if we're talking registered plans, you don't have to worry about that at all until you take the money out. But when the money comes out, it's a different type of income. It's taxed at your level of income when it comes out. But you don't have to worry about it going in. Here in Canada, we have something called a tax-free savings account, which doesn't provide a tax shield when you put money in. But as long as that money stays in there, whatever it earns, it's tax-free. So you never have to worry about an after-tax nominal return. You just have to worry about maximizing your pre-tax return without any consideration of tax. That's nice. Number 3, real returns. Inflation is a real thing, and here's the deal. Central banks are promoting inflation. They're always promoting inflation. They want inflation. They want to erode the purchasing power of your dollar over time because they feel that it has so many other benefits. Screw you on your purchasing power. You can at least try to get a return that beats that. That's up to you. That's your job to stay ahead of us. So real returns are made up of, well, you'd want some real risk-free rate, something for delaying compensation. And you have to compound that by the rate of inflation because you want to protect your purchasing power. And on top of that, you got to compound that by some premium for moving out of a risk-free asset. So the nominal rate that we get is made up of 3 different rates. A real risk-free rate compounded by an inflation premium. That just preserves purchasing power. Now we want some risk premium on top of that to reflect the fact that what we're investing in is not a risk-free asset. Now, these are all multiplied through, so what we can do is we can bring the inflation premium to the other side. So if we take our nominal rate and we divide it by the rate of inflation, we'll get a real rate of return. And the real rate of return is, here it is, it's the risk-free rate compounded by the risk premium. That's our real risky rate. In today's global economy, in most of the developed nations, inflation is really not an issue. In fact, deflation is more of the threat.